Welcome to Investing Confidential. The last few videos we talked about catalysts for this rally. So 3 catalysts. There were the midterms of CPI, Ukrainian peace. Now we're going to go through them all and tell you why this rally is most likely is a bear market rally and at some point will fail if it hasn't already failed already. So obviously the first catalyst we talked about was the midterms. Didn't work out, right? We don't know if we're going to have gridlock. It's very uncertain. Looks like the current administration is going to have the Senate again. They're going to keep the White House. They'll keep doing these policies. And again, these policies that are coming out are inflationary. I mean, this has nothing to do with politics, but they're very inflationary. And they continue to print money at rates that we have never seen before. So this is not good, okay? So without gridlock, this is not a positive outcome. Next was the CPI. CPI, as we have been saying for a number of weeks, the CPI has peaked. Okay, CPI came off. The market had this massive rally. So certainly, you know, this was a rally of short covering. Certainly, this was a rally that was in the cards, and it certainly was one of the biggest rallies we've ever seen anywhere in the markets, especially during what we have called a very vicious bear market rally. This was one of the most vicious of all bear market rallies, triggered by mainly the CPI. But then the Ukrainian peace was a backdrop of all this. Ukraine came out publicly right before the midterm saying, oh, you know, we want to go to the peace table. This was mainly because the Republicans were coming out very vocally saying they're going to cut off Ukraine. Well, obviously now the White House has the Senate. The House is on a thin razor's edge. So Ukraine is now back to war again. So unfortunately, that is not a catalyst. So at the end of the day, we really had just one out of the 3 created a vicious rally. But this rally is a bear market rally. So driven mainly by short covering. It was really a one-day move. We're not seeing much follow through here. Because at the end of the day, as we have spoken, we have talked about, folks, the market is really all about earnings, okay? And the perception of future earnings. And if you look at the recent earnings season, it was not good. Okay, there was a lot of very negative guidance. There was a lot of a lot of financial leering going on, especially companies, big tech companies manipulating their numbers. But at certain points, you can't manipulate the numbers. And at the end of the day, the future is just not good from a consumer. Again, from a global standpoint, we saw the effects of the dollar. We saw the effects of the weakening demand in Europe and China. So again, moving forward, we're already seeing signs that the companies are already coming out and saying, hey, we may have reached peak earnings in the short term. We've got problems. So if we look here at the first chart, S&P, forward earnings to S&P sales, what this shows you is we are on the verge of weakening margins, okay? This is not good for earnings. When you have weakening margins, it whacks earnings really good in an incremental basis. So we're going to see weak earnings going forward, and this cannot be, you cannot have a rising market in a weakening earnings trend and everything else, all the uncertainties around the global environment, the global economy. If the S&P, U.S. companies start to have weakening earnings, and they already have begun, it's not good for the entire market. So this will tell you that that we're in the midst, maybe the ending of another bear market rally, and this whole earnings thing is come into play. I want to mention a couple things here on this article about 60-40. I mean, this is a joke. This 60-40 hasn't worked for quite some time. I guess in the past, the 60-40 allocation was 60-40, mainly 60% bonds, 40% stocks. When one didn't do well, the other one offset it. I guess that worked for a while. But it's obviously was a way for wealth managers and all these other, the Blackstone, BlackRocks, and all these guys to sort of generate these type of fees, etc. But this 60-40 is gone, okay? Now that we have normalizing rates, okay, remember, we always talked about normalizing rates. I'm going to mention it again in this video, infinitum. All of these things that were done by Wall Street to make money, this is all blowing up, like the whole TINA issue as well. There is no alternative. You got to buy stocks. You got to buy stocks. That's gone. Okay, when you can get 3%, 4% on a 6-month piece of paper, a 1-year piece of paper, no reason to own stocks. TINA's gone. 60/40 is gone. You know what, folks? It comes down to one thing. We're going to go back to the future, okay? Back to really when what was the stock market created for? It was created for investors to buy into good companies, okay? And that's what we're going back to. I'm going to keep pounding this in. You need to do your own homework. You can't depend on the broker. You can't depend on anyone telling you what to do, because the ETFs, all these index funds, the mutual funds, they're going to underperform. They're going to underperform because even the mutual funds with money managers, they are closet indexers. They get paid by beating an index, not by making you money. You got to understand that. Okay, I'll repeat it again. They get paid for beating indexes, not making you money. So you need to start doing your own homework. You need to be educated. You need to see what the companies are doing and follow the companies, pick out good companies, et cetera, et cetera. So again, interest rate normalization is throwing the financial markets into a tailspin. So now we have the next Fed meeting, okay? About a month ago, people were getting really nervous. Okay, could we have 75 in December? Now they're talking less than 50 basis points. 50 base was baked in for a while. They're saying less than 50. I'm going to tell you right now. I'm not going to bet on it, but I'm going to tell you right now. It looks like the Fed's going to stand their ground. Okay, I told you before, I think Powell's weak. In fact, I know he's weak. He's a closet dove. But his reputation is on the line. He's got to continue. The Fed's got to keep talking a very, very hawkish stance. Okay, and I believe the Fed will stand their line ground, and they're going to do 50 basis points. So if the market starts baking in less than 50, you need to fade that. Okay, so I think Fed's going to do 50 because I think the Fed needs to stand their ground till they see more. Now, if you look at the Fed funds rate curve, okay, you're looking at, Fed funds being around 4% mid-2024. What does that tell you? Folks, that tells you that inflation, okay, is going to be sticky. Okay? Fed funds rate curve tells you, look at the chart, inflation is going to be very sticky. If it was going to come down, inflation was going to come down as fast as the market thinks it's going to come down, and the Fed's going to pivot at 2%, you wouldn't have this Fed funds curve. Okay, this makes sense. Okay, and you got to watch these things. This is something that CNBC or brokers aren't going to tell you. But so as much as we've seen inflation peak, it's not going to come down dramatically to this 2% target. Okay, before the Fed pivots, the Fed will pivot somewhere when they believe that that 4% is the new 2%. That's when they're going to pivot. But for now, all else, everything is pointing to inflation, very sticky. And look, why does that matter? Because we talked about earnings, and now here we're going to talk. Here we can see consumer sentiment. This just came out, University of Michigan consumer sentiment. This is not good. Okay, not good. It's plummeting, and it's obvious. Anyone who's watching this video, I think, agrees that they're not positive about the future, about spending a lot of money. If I told you, hey, go leverage up and buy a Porsche and go leverage up and take a huge mortgage and buy a house, nobody's going to do that. Nobody's going to do that because you don't know what food's going to cost 6 months down the road. You don't know if your energy bill is going to double in 3 or 4 months. It's not good. And if you look at this same consumer sentiment around the world, it's plummeting in Europe, in China, everywhere. So the U.S., the whole world, consumer sentiment is plummeting. And this is a consumer-driven economy. So what does that tell you about the slowdown in global economy? This is not good. And then you combine this with these layoffs. Okay, here's U.S. layoffs. Okay, they're rising very fast. This adds to consumer depression. So this is layoffs, not just tech layoffs, this is layoffs in general. This is going to add to consumer depression. And we've just begun to see the beginning of this rise. And I predict it's going to be significant. Okay, these are backward-looking indicators. So with all of this tech stuff going on and around, in the U.S., we're going to see this number rise pretty dramatically. The big news last night, if you haven't missed it, was China. Okay, so the Chinese market was up massively. The Chinese real estate stocks was up huge. It was one of the largest cap Chinese real estate was up 45% last night alone. And the reason these Chinese stocks were up was because the Chinese government put out some information that going to allow the banks who are literally bankrupt, okay, because a lot of their money is lent to the real estate industry, they're going to allow them to extend loans. Okay, look, they're just going to allow these companies to continue. The banks are not going to take the hit. Are the Chinese banks going bankrupt? Of course not, because the government has backstopped all the banks. They've backstopped all the real estate companies, and they got major problems, okay, because the whole industry is in decline. And so they had this big rally in China and Hong Kong. Everyone bought stocks. Hey, it was really short covering primarily. But the real problem with this supposed bailout is they're giving banks time to work things out. But what the Chinese government has not done, which they've done in the past, is to give some consumer incentives to change the sentiment on real estate. Real estate in China is sentiment driven. Okay, that's one thing a lot of people won't talk about. It's a sentiment-driven market. If the Chinese people believe that if they buy a piece of real estate today, buy an apartment today, and they're going to be they could potentially sell it in the future, they will buy. If they believe that the industry is in decline, and because again, a lot of this real estate is bought on investment. That's what people don't understand. A lot of these these empty cities that were out there, these zombie cities they talked about. Nobody was there. No, there were a lot of people there. They were just investors. So there were a lot of apartments. They looked empty. They were all purchased by speculators because over the last 20 years it worked. You bought an apartment in an unknown area, in developing area. You kept it empty for a while. Then boom, a renter came in or someone bought it out from you. So that's why all these supposed ghost cities, they weren't ghost cities. They were just cities waiting for people to come, and they came. Okay, that's not happening anymore. Okay, that's over. So without some incentives for the consumer, this rally is going to fade in China. Okay, it's going to massively fade. And I would have thought that they would have come out with consumer incentives way before bailing out the banks. So hang on to your hat. I don't think I would not be chasing this rally in China or China real estate without these consumer incentives. I just want to mention one last thing everyone's talking about FTX. Look, I don't think there's any more value to add on FTX. Watch my video from last week on Mt. Gox. I think that's one thing no one's talking about that I've been talking about. It's something that happened in 2012 to 14 time frame. This Mt. Gox had a big rise. It blew up like all these things do. It was the largest crypto exchange. They traded 70% of crypto. It was massive. It destroyed Bitcoin, relatively speaking, in one day, down 37% or plus. But in the end, it was the bottom. Okay, I don't know if this FTX thing is going to be the bottom. All I can tell you is, to me, from what I'm seeing, it's Bitcoin positive. Why is it Bitcoin positive? Because it's taking all of these cryptos, all of these useless cryptos there's too many of them. There's 2,000. They don't make any sense, and they're all going to zero. So the more these cryptos go to zero, you're going to see Bitcoin hang in there in price. People saying, why isn't Bitcoin down enough? Well, because the money's coming out. If it can, it should be going into Bitcoin. This is very Bitcoin bullish. I don't know where Bitcoin's going to bottom. Probably not at these levels, probably lower levels. I don't know. It doesn't matter. You should be watching the volatility of Bitcoin and the prices of the other cryptos. As the other cryptos go to zero, Bitcoin should catch a bid, and Bitcoin should go back to what the founders wanted it to be. So anyway, I tried to end on a positive note. And if you're an investor, be careful out there.